Hello guys, so today we're going to be talking about who controls supply and demand for currencies. Now I know if I ask who controls supply and demand for currency, what will be the question what will be the first answer you will give me? Let me guess. The government, right? You will tell me the government. But I'll tell you that is a lie. Supply and demand isn't controlled by the government for any currency. It's a goddamn lie. It's a lie that people are told, to keep them at bay. But today I'm going to show you who really controls supply and demand. So who controls supply and demand? First of all, supply and demand is controlled by the people. The people, yes, I said it, the people. Now the people elect a government. Now, after electing a government, the government creates two different special entities, which are the treasury for funding the government, and then the central bank to control interest rate and liquidity. Now, the treasury, in as much as its core function is government funding, also checkmates the central banks. But in rare cases, when I mean checkmate, I don't mean, oh, what are you doing? No. There are special ways they do that, manipulating the market. Yeah. So now the central bank, they also checkmate. In fact, I would say that their core one of the core principles of the central bank is to checkmate the treasury. Why? Let's go further. Now, what does the treasury do? They create inflation mostly. They create or reduce inflation. Now I'm going to tell you that for free. For instance, now when this government you elected, because I'm focusing mostly on monetary policy about currency and all of that, there are some things I didn't include in this graph. For instance, now if we're talking about a government, every money that every country generates goes to what? The treasury. Now the treasury, after a country passes a budget into law, now has to disburse this money to the different arms of government and institutions, ministries, that this money actually designated to according to the stipulations of the country's budget. Now, what happens when the income generated by the government, which is in the treasury, is lesser than what is required to run the government according to the bill or according to the government budget? What happens? So what happens is that is where these guys come in. They either reduce or checkmate or create inflation. What do they do now? When there is excesses, that is when there is an excessive spending compared to what is in the treasury, which means they have to generate more money. So what do? What they do is that the treasury prints or issues bonds to fund government excesses. Now, when they print this bond, the primary thing they do is that they auction it. So who do they auction it to? They auction these bonds to pension funds, insurance company, retail investors, foreign government, and commercial banks. Now, this is the normal thing they do. So how do they even, what do they do during this auctioning? The auctioning is also driven by supply and demand also. So during auctioning they have what we call coupon rates. You understand? When there is higher demand for these bonds at the auction, what happens is that yields fall. So but when there is lesser demand for these bonds that they are auctioning, yields go up, because when there's lesser demand, you have to increase the yield, which is like the rate, the interest you're going to pay them back, for patronizing the government or for funding the government, because what they are doing is just they are funding the government. So the interest you have to pay them back for giving you money to fund the government is what we call the yield. So if there is more demand, people are willing to borrow to the government, what is going to happen? The yield is going to fall because people even want this thing, so they are going to reduce the yield. But when there are less demand for these bonds being auctioned, they are going to increase the yield, and by increasing the yield, that means they are increasing the interest they are going to pay back to those people funding them, which are the pension funds, the insurance companies, the foreign government, the retail investors, and the commercial banks. So you see, mostly institutions are the ones that are even funding the government. Yes. So what happens now? This increment in or reduction in the yield can actually influence, which means if there is a high yield, oh, we're offering you, please, if you help us with this money to run the excesses of the government, we're going to give you a particular level of interest for doing that, which means the government is actually going to, more money. Okay, let's keep going. Let's not go deeper. But so now there's another thing that we have to look at, which are the central banks, which are very, very crucial for checkmating the treasury. I always keep saying that they checkmate the treasury. Now, in worst case scenarios in an economy, when the treasury doesn't, the demand for the bonds are going down, nobody wants government bonds, nobody wants their debt. Now, the central bank does what we call debt monetization. Now, what does debt monetization mean? It means that the central bank prints money to buy bonds from the treasury. Now, this is very, 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 very inflationary. It's inflationary. It increases money supply in the government in the country. So this is very, very inflationary. Now, understand also that the central banks actually determines the interest rates. So they either cut rate or hike rate, depending on whether the economy is becoming inflationary or deflationary. So what do they do? This rate actually affects the central bank specifically. Now let's look at the other side. Now, at the other side, we have the central bank actually hold bank reserves. And through this bank reserve, they can now do what we call quantitative easing and quantitative tightening. Now remember, central banks hold bonds, either the ones they bought through debt monetization, or there's another angle, they also buy from the ones that the commercial banks had bought from the treasury. The central banks can also buy it. Now, buying and selling it is now what we call quantitative easing and quantitative tightening. Then let's go further into the understanding of this concept. So let's define quantitative tightening first. Now, what is quantitative tightening? Now, let me put it in a broader, or let's say in a simpler form. Quantitative tightening is tightening the reserves of the central bank by reduction. That is, you are tightening the quantity. That is, you are reducing the quantity of bank reserves. That is the cash that you have for them, that the cash they are saving with the central bank, you are reducing it, you are tightening it. So that is a reduction in the quantity. Now, quantitative easing is that you are increasing it per se. So that is what is quantitative tightening. Now, when do we do quantitative tightening? When does the central bank do quantitative tightening? Now, what they do is to tighten the quantity of bank reserves. What they do is this: they have to they have to sell the bonds they are holding to the central banks. Now, the money for buying these bonds are going to be removed from the bank reserves. So when they sell this, they remove the money from the bank reserves, and now something happens. Now, when banks loan money, they loan money from the bank reserves. Does that make any sense? So by doing that, they have reduced the quantity of money in supply. Does that make any sense? Because you don't see money to borrow out again. So they have reduced the money that is being supplied. So by doing that, what have they done? Can you guess? Have they increased inflation, or have they reduced inflation? So yes. So when the central bank sells bonds to the commercial banks, what have they done? They are trying to reduce inflation. So it is disinflationary. It also decreases the money supply. It decreases lending, and it decreases the bank reserve. So now what happens when central banks buy bonds? When they buy bonds from these commercial banks, what happens? When they buy bonds from this commercial bank, what happens? They are going to now put back the money for that transaction in their reserves, thereby increasing the bank reserve, increasing the amount of money that they have to lend to people, thereby increasing the money supply, and then increasing inflation. So this is how demand and supply of currency are being, are being controlled. Yeah. So this is how it's being controlled. This is how it's being determined, right? So now what happens? The effect of these whole cycles going on here all comes to one place. That is, whatever has been happening, the government, the treasury, the central bank, everything comes to a particular point, and then everything also bounces back to the people. So at the end of the day, when you think that, there is a bunch of government that what is happening, this, then you are being very delusional. Everything starts from the people. The power is in your hands. You know what I mean? The government you elect, and then they determine the rest for you, because you send them to represent you, and whatever they do for you, and as such, you should bear the consequences of their actions. So at the end of the day, everything they do does what? Returns back to you. So it's like a cycle. It's a fucking cycle. So you see, now you understand who controls demand and supply for a currency. So who controls demand and supply for a currency? That is the people through the government. Then the treasury bill, you see the treasury, how they do their stuff, how the central bank operates, how all these cycles, just get to one place. Why did I actually, broaden this commercial bank? Because this is the closest that we are to money. This is the closest we are to money. So from here, we deposit, we loan money, blah blah blah. Few people, okay, insurance companies, but it's just for government workers and all of that, and countries that take it serious. Not every country take it serious, and this is the closest we are. Pension funds and all of that, retail investors, a little percentage of people, foreign governments, for like countries like the United States, Europe, UK, other countries buy their bonds, and all of that. So you see how all these cycles, has to actually play out to determine whether there is more money to be in circulation or less money in circulation. So now when we talked about supply and demand, you will now realize something. So our governments, through the treasury, if they create an excess, like if there's an excessive need of spending, we create inflation, which means there is money supply, too much money, without even considering are people actually in demand of this money. So if there is too much supply of money, and then lesser demand, what happens? The money starts to depreciate. The currency starts to depreciate, because the currency is the representation of an economy. In fact, that is true. That is the truth. The easiest way to represent the strength or weakness of an economy is through their currency. I know that banks, some strong economy, actually manipulate their currency to weaken it and all of that. But all things being equal, that is the easiest way to actually monitor the strength or weakness of a particular country. Sorry, I received a call. So these things actually determine the strength or weakness of our currency. Now, remember when we were actually talking, I remember when we were discussing the last time, I was like telling you guys, when I was using producers and consumers to explain the supply and demand, I was telling you guys that the producers are in a better place to actually know whether there is more demand for their product, or whether there is a lesser demand. So now, who is the closest to the treasury in this whole organogram? And who do you think is the closest? Central bank. They work in pari passu with each other. So they understand when there is a high demand for the currency and when there's a lesser demand for the currency, and with that they can either hike rate or cut rate or engage in quantitative easing or quantitative tightening because they understand this. So when you come to currency trading, you understand that the easiest people to pay attention to for clarity is the central bank. So you pay attention to the central bank. What are they doing? Are they hiking rates? Are they cutting rates? Are they engaging in quantitative easing? Are they engaging in quantitative tightening? So what is happening with them? So from there, listen to what they are saying. From there, you can make a very great decision to understand, is there a very high demand for this currency or is there a lesser demand for this currency? So from there, you could understand, okay, I'm having a bit of information to what is happening in the inside. So from there you can make proper and better decisions. So I believe I've done justice to this by giving you the basic knowledge about this. This is actually enough for you to really understand. And as we keep going forward, we'll actually discuss on how to understand what the central banks are pointing to us on what is happening on the inside. All of that, you understand. Okay, what are they doing now? Okay, what does this represent? When they're hiking rate, what does it mean? When they are cutting rate, what does it mean? When they are engaging in quantitative easing, what does it mean? When they are engaging in quantitative tightening, what does it mean? So I didn't talk about rate cut and rate hike, but that would come later on as we keep going, So, but you can do your quick research, understand when the central banks engage in rate cut, when they engage in rate hike. I wouldn't want to go into that now because these two things actually influence these two. They go in pari passu, but one of these happens when one of these. I wouldn't want to go into that now, and I wouldn't want to, confuse you. So let's just hold it here. I just wanted to explain this whole scenario so that you really understand. So who do you pay more attention to? Pay attention to what? The central bank. I know I see some people paying attention to, okay, how is the auctioning going and all of that. Yeah, people do that, but I tend to, it's easier, it's better, it's more clearer to pay because in fact auction goes on like almost every week, week in, week out and all of that, depending on the need for money, so it's better to pay attention to these people who have done the work to understand what is going on here and then make a decision, have a press conference, and then you understand, okay, you have the chairman of the central bank committee on rate decision and all of that coming out to give you a kind of hint on what's happening, what's going on and all of that. And from there you can now make a better decision and understand, okay, see what we are driving at. There is a higher demand for this currency, there's a lesser demand for this currency, see where the money is flowing out, see where the money is flowing out to and all of that. So this gives you a better understanding of the broader happening in the market. So everything about demand and supply for a currency starts with the people and ends with the people. So yeah, the power is in your hands. Don't blame nobody else. So that's it for this. Expect more on, as we keep going on, keep explaining some other things and keep making every other thing clearer and simpler. Now I promise you, after this you will not just be a beginner, you'll be a pro.